I'm Greg Brown for Newsmax TV Money. We're on the line with former presidential economic advisor and former Federal Reserve Governor Lyle Gramley, who these days is a senior economic advisor for the Stanford Group Company. Hello, sir, and welcome.
Thank you very much, Greg.
Plenty of gloom and doom out there in the headlines. Is a recession inevitable?
Well, I don't think it's inevitable, but it does seem likely. We won't know until the National Bureau of Economic Research opines on the matter. They're the official arbiter, and they're not going to tell us for quite a while. But the way the economy is developing, if we continue to see soggy economic performance in the second half, and that seems likely, then I think, they will decide we were in a recession.
You hear a lot about recovery depending on housing. Is a bottom in sight for home prices?
No, I don't think so. I think home prices will probably continue to decline until probably the middle of next year. I really think the issue about when the economy turns around and we get back into recovery again depends very much on the credit markets. They've been very dysfunctional since last August. We see no consistent signs of healing yet, and our economy does not function well without a smooth flow of credit. So we need to see credit markets begin to behave better, perform better, if we're going to come out of this slump we're in now.
That's the other question I was going to ask you about financial stocks. You keep hearing sort of the other shoe dropping every few days out of these companies. I'm wondering if there's a bottom there in your estimation anytime soon.
Well, again, that depends on whether or not investors begin to contemplate the bottom in home prices. As long as they are concerned about the possibility that another round of asset write-downs may happen, and that is their concern now, we're not going to see credit markets begin to improve.
Do you believe, as some do, that new regulation might help us avoid the next bubble, wherever it might be?
I think we're in for a new round of regulation in the financial sector. I think that's inevitable. I think everyone at this point agrees on it, on both sides of the political fence, in the administration as well as in the Congress. We're going to have to be careful in adopting new regulations that we don't stifle innovation in financial markets, but it's clear that dependence on self-regulation and market discipline, which we were relying on perhaps too heavily earlier, are not enough. We're going to have the federal government step in, particularly regulating institutions that are large enough to cause systemic risk.
Interesting. Former Fed Chair Alan Greenspan takes a lot of flack for the current mess. Is that fair at all?
Well, I think the Fed has a little bit of responsibility for what happened in terms both of keeping interest rates a bit too low in 2003 and not seeing what was developing in the housing market in terms of the increasing laxity of underwriting standards. But no one foresaw this develop, or at least very few people did. Investors around the world, for example, were very happy to buy these sloppily underwritten mortgages, so you could blame them too. You can blame the credit agencies for not being on top of the job. There's just an awful lot of blame to go around.
Of course. We end up, as usual in these matters, debating the Fed's real role vis-a-vis jobs, the economy, and stocks. What's your view?
Well, the Fed doesn't have any direct responsibility for stocks. It certainly does for the performance of the economy and for inflation. The Fed's goal has been described by law as maintaining maximum employment and price stability. Right now, they're in a situation in which those two goals appear to be in conflict, at least in the short run. But their behavior in the past 6 months indicates quite clearly that they think the major danger facing our economy now is weakness that could accumulate into quite a considerable downward spiral. So they're going to put off their fight against inflation until a later day.
That's the last question I was going to ask you, if I could, this morning about a Fed. You hear a lot, particularly from Richard Fisher and other people on the Fed, that the rates have to go up, they have to go up, they have to go up. I take it your view is that they probably do, but not soon.
That's right. I don't think the Fed should start raising interest rates or will start raising interest rates until we see credit markets begin to perform better and the economy evidently in a path of growth that can be sustained longer run. And I don't think we'll see that those conditions exist before sometime early next year.
I've also heard another theory, and it's been bouncing around, that both the European Central Bank and in the United States are betting in a way that the both big economies here in the Western world will slow down and put off the need for a Fed hike in interest rates. I'm wondering if that's an accurate bet on their part.
Well, I think the world economy is going to slow down a bit, and that's going to help take some of the pressure off basic commodity prices, particularly oil. And oil prices are also being affected by efforts at conserving on energy by individuals who are driving a lot less these days. But whether or not we have an inflation problem here to deal with depends more than anything else on the performance of our own economy. If our economy is weak and we have continued strong increases in productivity, such as we've had recently, then I think this inflation problem is going to take care of itself.
The weak dollar we've had of late, good news or bad news for the economy?
Well, it's a double-edged sword. I mean, it does improve our competitive position, but right now it's adding to inflation pressures at a time that we don't want that. So I think we don't want to see the dollar fall any further at the moment.
Yeah. Do you think it needs to strengthen?
I think it can strengthen against the major currencies of the world, such as the euro. There was a story in the Wall Street Journal of several weeks ago about Europeans who were buying European-made cars in the United States, shipping them back to Europe because they can save 20 to 30% that way. That tells you that the dollar is undervalued relative to the euro. Still, the dollar does have to decline further over time against the currencies of the emerging nations, particularly those in Asia, such as China, for example. But that doesn't have to happen right away.
Of course. We've been talking with former Fed Governor Lyle Gramley. Thank you, sir, so much for your time.
You're most welcome. Good to chat with you. Bye-bye.
Thank you. I'm Greg Brown for Newsmax TV Money.